Here is something strange about the way money moves in the world right now. Somewhere in London, before the sun is fully up, a fund manager pours a coffee, sits down at a bank of screens, and does not look at the FTSE, does not look at the S&P futures, does not look at anything that has to do with his own home market. Instead, the very first thing he checks, the number that tells him what kind of day it's going to be, is a stock index on the other side of the planet, in a country most of his clients could not find on a map without a moment's hesitation. He checks Seoul. He checks South Korea, because on one Thursday in the summer of 2026, that market did something that made the entire financial world sit up straight in its chair. In a single trading session, two companies, just two, lost a combined figure that runs into the hundreds of billions of dollars, not over a month, not over a bad quarter, in hours. The whole national market fell so fast, so hard, that the exchange itself hit an automatic brake, a circuit breaker, a mechanism that literally pauses trading because the machine has decided humans need a moment to catch their breath. And here is the part that should make the hair on your arms stand up. That crash, in a mid-sized Asian market that most people never think about, is now the thing that professional investors watch to figure out what is about to happen to the biggest, most crowded, most talked about trade on Earth, artificial intelligence. If you want to know where the AI bubble breaks first, before it shows up on Wall Street, before it hits your retirement account, before the headlines catch on, you don't watch New York, you watch Seoul. So here's the question this video is really about, and it's a stranger one than it first appears. Why there? Why has one relatively small stock market, in a country of about 50 million people, become the world's early warning sensor for a trillion-dollar global mania? A year ago, if you'd told a room full of American investors that the health of the entire AI trade could be read off the Korean stock index, most of them would have laughed. Korea was a peripheral market. Interesting, sure, good companies, strong exports, but not the kind of place you'd stake your read of the global economy on. And now? Now the biggest banks in the world are running dedicated presentations on it. Trading desks in Tokyo and Hong Kong have added it to the very top of their morning watch lists, and that fund manager in London is checking it before he checks his own backyard. Something changed. And the thing that changed is not luck, and it's not noise, it's structure. It's the actual anatomy of how that market is built, and once you see it, you can't unsee it, because it explains not just why Korea moved, but why it was always going to move first. Now, before we go 1 inch further, let's be honest and careful, because this is exactly the kind of story that gets told badly. You will see headlines, you've probably seen them already, that say the AI bubble popped in South Korea, past tense, done, over. And that framing is, to put it plainly, too neat to be true. Yes, that market fell roughly a quarter from the peak it hit in June of 2026, a wipeout somewhere in the neighborhood of $1 trillion of value. Yes, it briefly slid into what traders call bear territory. Yes, it tripped those circuit breakers more than once. Every one of those things is real and dated and serious. But in the very same stretch, that market also rebounded around 8% in a single day. And here's the number that stops the doom story cold. Even after the crash, even after the panic, that index was still up something like 70% for the year. 70. So whatever happened in Seoul, the bubble popped, is not an accurate description of it. What actually happened is more interesting and more useful than that. It was a violent repricing, a market being stress-tested in public, in real time, with the whole world watching to see whether the thing it's built on can hold. This video is not here to tell you the crash is coming or that it isn't. It's here to explain the machine, why this particular market became the pressure gauge for the whole AI trade, and that explanation stays true whether tomorrow's session is red or green. And I want to say this clearly and once, so we're square. Everything you're about to hear is analysis of public market data. It is not financial advice. It is not a signal to buy anything, sell anything, or touch your account at all. Nobody here is going to tell you what to do with your money, because the honest, valuable thing, the thing worth 29 minutes of your attention, isn't a prediction. It's understanding. It's the ability to look at a scary headline about a foreign stock index and actually know what it means and what it doesn't. So let's start where the story actually starts, which is not with the crash at all. It starts with a slow, quiet transformation that happened over the course of about a year, mostly out of view, in the plumbing of a single national index. Because to understand why two companies could yank an entire country's market off a cliff in one afternoon, you first have to understand a fact that sounds almost impossible until you sit with it. In that market, those two companies are not just important. They are not just big. They are, between the two of them, roughly half of the entire index. Half. Out of hundreds and hundreds of listed companies, car makers, banks, shipbuilders, steel makers, retailers, everything a modern economy contains, two chip makers now carry close to 50% of the whole thing's weight. And a year earlier, that same pair accounted for closer to a quarter. So, in the span of 12 months, their grip on the market didn't just grow. It doubled. And that single fact, that shift from a quarter to a half, is the key that unlocks this entire story. So sit with what that actually means, mechanically, because this is the part most people skip right past. When two companies make up half of an index, that index stops being what most people think an index is. Most of us carry around a mental picture of a stock market as a kind of thermometer for a whole economy. Thousands of businesses, millions of decisions, all averaged together into one number that tells you roughly how the country is doing. That picture is comforting because it implies safety in numbers. If one company stumbles, 900 others cushion the fall. Spread the weight, spread the risk. That's supposed to be the whole point. But that only works when the weight is actually spread. When you concentrate half of it into two names, the arithmetic quietly flips on you, and the thermometer becomes something else entirely. It becomes a bet. A single, focused, high-stakes bet on one story, the story of artificial intelligence and the hardware it runs on. And here's the mechanical consequence, the thing you can almost feel once you see it. On any given day, those two chip makers can move in one direction while every other company on the exchange moves the other way, and the index will still follow the chip makers. The other companies don't get a vote that counts. You can have a good day for the car makers, a good day for the banks, a steady day across the broad economy, and if those two chip giants drop 4%, the whole national market goes red anyway. The 900 are along for the ride. Their opinion has been mathematically outvoted before the opening bell even rings. That's what concentration does. It takes a broad instrument and turns it into a narrow one wearing a broad instrument's clothes. And this is why, when you saw those headlines about a country's entire stock market falling 8% and tripping a circuit breaker, the accurate translation wasn't "a nation's economy collapsed in an afternoon." The accurate translation was, two specific companies had a very bad few hours, and because they now are the market had a very bad few hours too. The label on the tin said National Index. What was actually inside was a leveraged wager on memory chips. Now, you might reasonably ask, how does that even happen? How does an index that was reasonably diversified drift into being half-owned by two names in the space of a year? And the answer isn't manipulation, and it isn't an accident. It's success. Ferocious, concentrated success. When a company's share price triples and then keeps climbing, its slice of the index swells automatically because most major indexes weight their members by market value. The bigger you get, the bigger your vote. So as those two chip makers rode an extraordinary wave of demand, their weighting didn't just grow because someone decided it should. It grew because the machine is built to hand more and more of the steering wheel to whoever's winning. Winning begets weight, and weight begets more influence over the index, and pretty soon the tail isn't wagging the dog. The tail is the dog. The other 90-something% of companies became, functionally, background scenery. And I want you to notice how invisible this process is while it's happening. Nobody rings a bell when an index crosses from diversified into concentrated bet. There's no alarm, no regulator standing up to announce that the thermometer has quietly turned into a thermometer-shaped casino chip. The weightings just creep, month by month, quarter by quarter, in the small print of index fact sheets that almost nobody reads. A quarter becomes 30%. 30 becomes 38. 38 becomes something close to a half. And every step of the way, the number on the screen, the headline index level, kept going up, which made everyone feel great, which made the concentration feel like a feature rather than a fragility. That's the trap inside every concentration story. On the way up, it looks like strength. The narrowness that makes a market dangerous is the exact same narrowness that makes it soar. You cannot have one without the other. The rocket fuel and the risk are the same substance. So by the time we get to that violent session, the one that made global headlines, the setup was already fully loaded, months in advance. The market had, without anyone deciding it in a single moment, transformed itself into a pure-play instrument on one theme. And when you build a machine like that, you have also, whether you meant to or not, built the most sensitive early warning device in the world for that theme. Because the moment sentiment shifts on AI hardware, the moment a single doubt creeps in about how much memory the world will need, or how fast, or at what price, this market feels it first and feels it hardest, precisely because it has no ballast left to absorb the blow. It stripped out its own shock absorbers on the way up. That's the bill that came due in a single afternoon. But concentration alone isn't the whole mechanism. It explains why the two companies move the index. It doesn't yet explain why the whole planet decided to care what those two companies do, why traders in London and New York and Tokyo started pulling up a foreign index on their screens before they'd even looked at their own. For that, you have to understand what these two companies actually make. Not chips in the loose general sense that everyone waves at when they say chip stocks, something far more specific, far more load-bearing and far harder to replace. Because it turns out these two firms don't just participate in the AI build-out. They supply a single, narrow, absolutely essential component that nearly every advanced AI system on Earth cannot run without. And there is no easy substitute, no second shelf to grab it from, no quick way around them if they stumble. And that component, that quiet choke point hiding inside every AI data center being built right now, is where this story turns from a tale about one market's math into something much larger. So let's follow the part itself. All the way from a hot factory floor in Asia to the humming server halls in the middle of the American desert, and watch what it touches on the way. The part is called high bandwidth memory, HBM, if you want the shorthand the traders used. And to understand why it matters, forget the word memory for a second, because it makes the thing sound trivial, like the extra storage you buy for a laptop. That's not what this is. Think instead of a starving engine, an AI accelerator, the expensive processor at the heart of every training run. The piece everyone photographs and puts on magazine covers is a monstrously fast eater. It can do arithmetic at a speed that borders on the absurd, but it can only work on data that's sitting right next to it, close enough to reach in a fraction of a second. And here's the cruel little secret of the whole AI boom. The processor is almost never the bottleneck. The bottleneck is feeding it. The bottleneck is getting data to the engine fast enough that the engine isn't sitting there idle, burning power, waiting for its next bite. That's the job high-bandwidth memory does. It stacks memory chips vertically, layer on layer on layer like floors in a tower, and wires them together with thousands of tiny vertical connections so that data can pour into the processor through an enormously wide pipe instead of a thin straw. It sits physically inches from the accelerator, sometimes on the very same package. Without it, the most expensive processor in the world is a race car with a garden hose for a fuel line. With it, the engine runs flat out. So every time a company announces another giant cluster, tens of thousands of accelerators, a building the size of several football fields, a power draw that rivals a small city, buried inside that announcement, unmentioned in the headline, is a mountain of this specialized memory that somebody has to manufacture, and almost nobody can. That's the word that changes everything, almost. This is not memory you can order from a dozen suppliers. Making HBM is brutally difficult. You're stacking delicate silicon wafers on top of each other with near-perfect alignment, drilling microscopic channels straight through them, and doing it at a yield high enough that you don't throw away half your production. The number of firms on the planet that can do this well, at volume, that the biggest AI chipmaker will actually certify and buy from. You can count them on the fingers of one hand, and you'll have fingers left over. And two of them are the two companies that now make up half of this one national index. So follow the chain and feel it lock into place. The AI trade rests on a handful of accelerator makers. Those accelerators are useless without high bandwidth memory. That memory comes from a tiny cluster of firms, and a market you might have ignored a year ago happens to hold the crown jewels of that cluster. That's why the whole planet started watching. It isn't sentiment. It isn't fashion, it's plumbing. When a fund manager in London pulls up that foreign index before her own market opens, she isn't being exotic. She's checking the pressure gauge on the one pipe the entire AI build-out flows through. If HBM demand is roaring, these two stocks roar, the index roars, and it tells her the accelerator orders behind them are real. Real enough that somebody is buying the memory to feed them. And if those two stocks wobble, she has to ask the far more frightening question. Is somebody, somewhere up the chain, quietly slowing their orders? Because the memory gets bought before the data center gets built. The choke point reprices before the headline does. And this is where the canary stops being a metaphor and becomes something close to literal. Coal miners carried canaries underground because the bird's small body reacted to poison gas long before a human would feel it. Not because the bird was more important than the miners, because it was more exposed. It sat closest to the danger, breathed the thinnest margin, and so it registered the threat first. That is precisely what this market has become. It is more exposed to the AI trade than any broad index on Earth, because it stripped itself down until it was almost nothing but the AI trade, concentrated into two names that sit at the narrowest point in the entire global supply chain. It breathes the thinnest air. So when the gas shifts, when a single credible doubt drifts in about how much memory the world will actually absorb, or whether prices have run too hot, or whether the build-out is finally pausing to catch its breath, this market feels it in its lungs before anyone up in the fresh air feels a thing. Now hold that image, because it explains the violence of that single session in a way that plain concentration never could. On that afternoon, a whisper moved through the market. Not a collapse, not a bankruptcy, nothing so clean. Just a shift in tone, a worry, half-formed, about whether the memory supercycle had climbed too far too fast, whether the orders humming through that narrow pipe were about to thin. And in a normal, broad, ballasted market, a whisper like that gets absorbed. It bumps a few stocks, gets argued about, fades by lunch. But in a market that had become a pure play bet on exactly that one theme, concentrated into exactly the two companies at exactly the choke point the whisper was about, there was nothing to absorb it, no ballast, no unrelated sectors holding steady while the worried ones fell. The doubt hit the two heaviest names in the index, and because those two names were half the index itself buckled. Hundreds of billions of dollars in value evaporated in hours. Circuit breakers, the automatic pauses that halt trading when a market moves too far too fast, actually tripped, freezing the screens, And still we haven't touched the piece that turns a sharp fall into a genuine free fall, the accelerant layered on top of the concentration and the choke point. Because it isn't only what these companies make, or how much of the index they are. It's who is doing the trading and how much borrowed money is riding on every single move. And that is the third gear in this machine, the one that turns a steep drop into something that feels like the floor giving way. Because this is a market unusually rich in leverage, money that isn't really there, borrowed against positions, amplifying every gain on the way up and every loss on the way down. When a heavily leveraged position moves against the person holding it, they get a call. Sell now, or we sell for you. And when the biggest names in a concentrated index start falling fast, those calls go out all at once, forcing sales into a market that is already dropping, which pushes prices lower, which triggers more calls, which forces more sales. It's a chain reaction, self-feeding, indifferent to whether the original whisper was even true. The market isn't reacting to the news anymore at that point, it's reacting to itself. Layer that on top of a heavily retail-driven trading base, enormous numbers of individual investors, many trading with borrowed leverage, many watching the same screens and feeling the same fear at the same instant. And you get a market that overshoots in both directions, almost as a matter of physics. It doesn't move like a broad economy. It moves like a crowd running for one exit. And here is the part worth sitting with. That same violence, that same tendency to overshoot is exactly what makes it a leading indicator instead of just a victim. A calm, ballasted, diversified market prices a new worry slowly, over days, absorbing it in pieces. This market prices it in an afternoon, in full, in a spasm you can see from across the world. It gets to the answer first, messily, loudly, sometimes wrongly, but first. Which is why desks in New York and London and Tokyo started doing something they'd never bothered to do before, checking Seoul in the morning, the way you'd check a gauge before descending. Not because it always gets it right, because it always gets it early. So here's the honest turn, the part that separates analysis from fear farming, and it matters more than any scary number in this entire story. Everything I've just described, the concentration, the choke point, the leverage, the overshoot, cuts both ways. It is not proof the bubble has burst. It is proof this market is the most sensitive instrument we have for measuring the AI trade's mood, and a sensitive instrument twitches at things that turn out to be nothing. Remember, this same market that fell so hard also rebounded 8% in a single session, one of its sharpest up days on record. And even after all the drama, it sits up roughly 70% on the year. 70%. That is not the fingerprint of a market that has died. That is the fingerprint of a market having a violent argument with itself about how good things actually are. The very companies at the center of the fall drew commentary from further up the supply chain, framing the dips not as warnings but as buying opportunities. The argument being that the demand for this memory is real, the earnings behind the concentration are real, and the supercycle is intact, not imaginary. And that argument might be right. Concentration isn't automatically mania. Sometimes a handful of names dominate an index because they genuinely are where the value is being created. A sharp repricing is not the same thing as a collapse, and anyone who tells you the difference is obvious in the moment is selling you certainty that doesn't exist. So what do you actually watch, if not the daily red and green? Not a prediction, indicators. Watch the price of the memory itself, that high bandwidth memory flowing through the choke point. If those prices hold firm, the supercycle story has legs, and if they soften, the doubt has teeth. Watch the capital spending guidance from the giant firms building the AI infrastructure. Their budgets are the oxygen this whole trade breathes, and any real hesitation there shows up in Seoul first. Watch the foreign investor flows in and out of this market, because that's the fresh air deciding whether to come down the shaft or climb back up. And watch the concentration itself. Whether those two names keep swelling as a share of the index making it an even purer, even more fragile proxy, or whether the market broadens back out and regains some ballast. None of that tells you what to do with a single dollar of your own money, and I'm not going to pretend it does. This is analysis of public data, not personalized financial advice, and the honest truth is that the same structure that makes this market a brilliant early warning sensor also makes it a terrible thing to bet the farm on in either direction, which brings us back to the canary one last time. The miners didn't panic every time the bird fluttered. They also didn't ignore it. They watched it, calmly, because it told them something about air they couldn't feel yet. And the skill wasn't in reacting to every twitch, it was in knowing the difference between a startled bird and a dying one. That is the entire posture worth carrying out of this. A small market on the far side of the world stripped itself down until it became the most exposed, most concentrated, most leveraged bet on the single biggest story in global finance. And in doing so, it turned itself into the instrument that reads that story first. Not the most important market, the most exposed one. And exposure, it turns out, is what makes something worth watching. Whether the next session is red or green, whether this was the first crack of something larger or just a sensitive market flinching at a shadow, that structure stays true, and that's the thing worth understanding. So here's what I want to know from you. When you look at that 8% rebound and that 70% yearly gain sitting right next to $1 trillion briefly wiped away, do you read that as a canary catching the first whiff of poison gas or as a nervous bird startled by its own shadow? Tell me which one you see and tell me why. I read every answer, and I'm genuinely curious where you land.